Hello everyone. Every day at least one person asks me to suggest some good stocks to buy, but I really don't want to do that. Still, I have noticed these two small company stocks which seems cheaper than others right now, even though most of the small cap stocks are expensive. For example, according to Bloomberg, both Nifty Small Cap 100 and Nifty Mid Cap 100 are trading higher than that of their 5 years average P valuation. And it used to be Nifty to trade at a higher P ratio than that of these small cap. All those changed sometime during May-June period, where now small cap becomes at least 20 to 30% expensive, but there are still some steam left in few selected stocks. So in this video, I like to discuss about those small cap companies whose growth and future outlook make them to stand out. Again, not like traditional complete fundamental analysis, rather than I'll just tell what makes them special from my perspective. Just a disclaimer, I'm not SEBI registered, and this is not a recommendation and it's not a buy or sell call. It's just an educational video, and at present I owned none of these stocks, and today I don't have any plan to buy either. The purpose of the video is just to introduce us to these stocks, that way we can keep an eye on them. I found these two stocks from the BSE Small Cap Index that have grown well recently but are cheaper compared to other companies in the same industry. And also, in direct contrast to the small cap index, these stocks are trading lower than that of their 5-year average P ratio. So without delay, let's get started. First, Mahanagar Gas. They distribute the natural gas mainly in Mumbai and Thane region. For homes, they supply it as piped natural gas, and for automobiles as compressed natural gas, otherwise in common term CNG. Regarding revenue growth, in the last 10 years, it increased on an average 10% each year. Especially in the past year, their sales grown by more than 45%, and that revenue growth transferred in profit as well, as it increased over 32%. In comparison, the sector's average net profit growth was just 5%. Mahanagar Gas always maintained the profit margin that in the range of 15 to 25%. Especially in Q1 FY24, its margin is in the upper band. So last year alone, sales grown by 45%, profit increased over 30%, and it's a zero debt company. Despite all this positivity, right now Mahanagar Gas Limited stock is trading for 30% less than its usual PE ratio over the past 5 years. Its historical PE ratio ranges between 13 to 17.5, and at present it trades at just 11.45. Here, Indraprastha Gas and Gujarat Gas Limited is their direct competitors. Indraprastha Gas trades at 19.67 PE ratio and Gujarat Gas at over 21 PE ratio. Even if we compare all the others established big companies in the sector, Mahanagar Gas is at least 50% cheaper. And one more specific positive news on Mahanagar Gas Limited is, in last March, they acquired 100% stake of Unison Enviro Private Limited. Now, this acquisition made them to expand in the new 5 more areas, 3 in Maharashtra and 2 in Karnataka. Again, this also provides some of the new opportunity to grow. So, is it all positive in this? No. There are a couple of negative as well. First, their main disadvantage, government decides the selling gas price. And Mahanagar Gas Limited does not have any pricing power, neither from the suppliers nor from customers. However, on the positive side, so far they have maintained good net profit margin and operating profit margin. Second, in 2024 and 2025, global analyst expects the drop in natural gas price. So in those scenarios, it might affect both revenue and profit. But in both the case, it's an industry or sector specific issue, not just for Mahanagar Gas Limited alone. Like how this sector specific disadvantage, they also have the sector specific advantage. So far they are having 5042 kilometer gas pipeline network in Mumbai and Thane region. Here no competitors can replace that, and in their respective region they got the regulatory approvals for digging the roads, so those will be challenging for any new entrant on those region. In addition, for the customers, there will be a switching cost. All those creates some kind of monopoly. In conclusion, despite operating in an asset-heavy industry, Mahanagar Gas Limited has maintained zero debt levels and increased the customer base. It has been very consistent in paying the dividends, and also it has maintained its operating and net profit margins throughout the years of variable natural gas prices, even when the input and output prices are governed by external factors. One more important factor, in the last 7 years, all the time the credit rating of Mahanagar Gas Limited is always AAA, which is really a good sign. However, there are some project execution challenges in the newly acquired areas, so that we need to keep tab on it. However, on the valuations front, the PE ratio of Mahanagar Gas Limited is under 12 and it's less than its own historic and the peer companies. So I think this company is very reasonable valued conservative stock. Second, AIA Engineering Limited. Small intro. It's an Ahmedabad-based Indian manufacturer of grinding equipment used in mining, cement and power sectors. In that, over 70% revenue comes from mining and 29% comes from cement sector. Location-wise, the revenue break is 73% from UAE and 27% in India. Basically, this company which sells important goods for other business, which all are good, but the problem is this business is somewhat cyclical in nature because its end users are cyclical. However, their marketing strategy is always go for aggressive capacity expansion. I mean, if you see their capex, we can totally understand that. In FY22, it was just 131 crore rupees. Then last year, it increased to 195. And for this FY 2024, expects to increase 250 crore rupees. And in the next 2 years, they plan to spend 56% more money compared to what they spent in the last 2 years. But still their debt to equity ratio is very low, respectable 0.09. Now coming to the revenue, in the last 2 years their revenue increased on an average 30% each year, and if we compare the last June quarter to a year ago, it still increased by over 20%. And by Money Control Analyst, they expect the revenue to grow at least by 10% in the next 2 years. In addition, if you see the operating profit margin, in the last 1 year, they increased it to about 25%. In comparison, their historical average is just 20%. So clearly, their growth and fundamentals looks good and the company is not debt but almost debt free. Now in valuation part, if we compare its own historical PE ratio in the last 5 years, mostly it's above 30. However, at present it's trading near 28. And the stock price is at least 25% cheaper compared to other similar companies based on how much money they make. Above all, this year their management said they are expanding aggressively in North and Latin America. So those are the positives. But what's the negative in it? First, though the operating profit margin is quite good now, but if you see that in the long run, the company has a significant fluctuations over the years. I mean, during FY 2011 to 2014, the operating profit margin declined consistently to 14% from about 27%. Thereafter, during FY 2015 to 2017, the operating profit margin recovered to the levels of 28 to 29%. However, the recovery was short-lived and in FY 2018, the operating profit margin declined sharply to 22%. Now again, it improved to 25%. The reason behind that is its price fluctuations on the raw material. I mean, AIA Engineering Limited uses metal scrap, primarily steel and ferrochrome as primary raw materials, which forms more than 40% of its total cost. And if you see the steel future price, it used to fluctuate between 20,000 to 40,000 rupees. Now that band in the last 5 years, it shifted to 40,000 to 60,000 rupees. And at present, it's close to the lower spectrum. Here, company claims that they have been able to pass the price fluctuations to the customer. But for that, I can't able to find the credible source, or this statement doesn't stand well with the operating margin fluctuations. Second, as I said earlier, their business is somewhat cyclical because the company supplies to customers belonging to the mining, cement and power sectors which are cyclical in nature. Finally, if you see the analyst recommendation in Money Control website, almost all the time at least 10 analysts recommends this to buy and none of them recommends this stock to sell. In summary, AIA Engineering is a quality company with an established track record and high customer stickiness due to their network effects, and the company has a clean track record of corporate governance. However, it is somewhat constrained by the cyclicality of its end customers, which also exposes it to raw material fluctuations. Hence, the company can surely be bought at a reasonable valuations as it will have a high rate of investment with a incremental capital generation. So that's it. These are the two small cap companies that are interesting because of their growth, future plans and current stock price. So that's all in this video. Hope you all got some useful information. Please consider subscribing the channel and liking the video so it will help me beat the YouTube algorithm and also motivate me to do more. Please don't make any investment based on this as I'm not a SEBI registered advisor. I am doing this for my and viewers' educational purpose only. Thanks for watching.